Welcome to the Elevate and Execute podcast, where the big question is this: how do we elevate our lives and our businesses to do more? We talk about real estate, life, and whatever the hell we want. Welcome to the show. What's up, guys? Welcome to the show. So today we want to talk about something exciting. It's, I was looking at, retirement options. I think all of us have had a corporate gig where we had a 401k or an IRA and, prescribed to this standard way of retirement, vehicle of retirement. And I wanted to take that and kind of compare it to what we've all found now, which is real estate and specifically using rental property as a retirement vehicle versus your traditional 401k, and kind of talk about the differences between the two. I've done a lot of research in the last week on this, and I'd love to get kind of just some banter going back and forth on this.
Go ahead. You're the expert.
Right, yeah.
Yeah. So first of all, let's talk about what is a 401k. You guys know?
I mean, I know what it is, but it's you're probably going to school me on it.
I got rid of mine.
Yeah.
When my wife came home and said she signed up for her employer's 401k, I said, "There's no way you're going to be able to run that far." It's usually something that you get with a job and kind of another
the benefit package.
Benefit package is the employer may
they're investing into mutual funds and they might match, which is what 6% is the max that you see. That's pretty good if you're getting a 6% match, which means let's talk about the match. If you're putting in 6%, they're going to match it at 6%. You're putting in 5%, they're going to match it at 5%. And they are in mutual funds, probably 100 of them, right?
Yeah. Yeah, a lot of them are limited to what you can invest in certain mutual funds, certain company funds, stuff like that.
It's a long-term play, right?
I know when I was at the corporate gig, I had to sign some extra forms and take some training so that I could actually be investing in the stock market. And so they do let you, I think, in some companies, invest in the broader stock market, but you're still going to be limited to mutual funds, stocks, and bonds.
So could you go in and manipulate it? Could you go in and change funds?
I can go in and I can buy stocks. I can buy index funds. I can do so. The majority of the research I was doing is like, okay, well, there's a lot of risk if you're going to put your retirement into one stock or something like that. So most people would suggest investing in the S&P 500 index, which is the top 500 stocks in the U.S. And that's usually what people are talking about when they say, hey, the stock market's going up, stock market's going down. They're talking about the S&P 500. That tracks the biggest stocks in the country. And over the last 30 years, what do you guys think the return historically has been over the last 30 years on a year-by-year basis for the S&P 500?
Between 4% and 8%.
I was going to say, 3 to 5. 5 being super aggressive, so probably more than the 3.
3? Okay. Well, you'll be surprised to know that it's about 10%.
No shit.
10% average annual return over the last 30 years.
Okay.
So,
that's good.
Yeah.
I mean, that is good for what?
That's more than I... obviously more than I thought it would be.
And if you were in the bond market, so bonds are traditionally very safe, stable investments. Yep. So like the 10-year Treasury bill right now is at 4%.
Okay.
So that's kind of because
that's what dictates interest rates, right? Is that
yes, so when we have high inflation like we've had the last couple of years, all of these returns go way up, right? So traditionally, bonds usually aren't paying 4%, but because there's been so much inflation, that's part of why you're getting up. Yeah, right. That's why you're getting those high returns. Inflation. That's why you're getting 10% year over year. That's why the price of a house has drastically changed over time. And so when we compare that to investing in rental properties, what do you guys think the average annual return for real estate has been over the last 30 years?
Investment property? Are you talking like you've been in
just real estate across the country?
Are we talking appreciation?
Appreciation, average annual appreciation last 30 years.
13%.
Oh, very nice.
Hold on. This is the trick question.
This isn't a trick question. So, yeah, average national appreciation over the last 30 years.
I'd say, let me guess.
Yeah.
I'm going to guess 21%.
21, dang.
That's a lot.
Super high.
We're high, I guess.
We're 7%.
7%. So
yeah.
traditionally,
So wait a
the stock
second.
market does better than real estate.
In appreciation, right?
Okay.
Yeah.
I know the only reason I guess so high is because I know that you're at the end of it, somewhere in this, you're going to say that real estate's a better investment because we all know that.
Yeah.
So how?
Yeah. Well,
I mean, we've always been taught 4 to 7% annual appreciation in real estate is normal.
Yeah.
But in the last, well, you said 30, but really in the last 5 to 10, we've been seeing off numbers that are off the charts, right?
Yeah, you're right.
Because of low inventory and low interest rates. Like think about during the COVID boom, you're probably talking 30% or higher.
We had, I think the high was.
Are you kidding me? When interest rates were 2.5%, I guarantee you the appreciation was 30% in those.
It was low 20s, but yeah, there was.
During that cycle?
2022 was the biggest year for that.
Yes.
It was like 20%.
It was crazy.
Yeah, it was really high.
And it's starting to balance out now, though.
I would agree.
Yeah. But you're right. I mean, it's stepped up. So if you go back 50 years, it's more like a 4% appreciation. Last 30, we're at 7. Last 10, we're close to 9. Last 5, we're at like 12. So it's been stepping up steadily over these last couple of years. But I like to take a bigger look at 3 decades worth of data to kind of see where we're at. And what's cool is in the last 30 years, the real estate has only gone down in value 3 of those years, between 2008 and 2011.
Sure. We always, it was 3 years in a row.
Yeah, 3 years in a row.
Wow.
And every other year we've been in the green,
That's
which is
crazy.
super cool.
Because
we're doing liar loans.
Yeah.
But people are so scarred by that.
Yeah.
They're so scarred by those 3
Well, they
years
don't
when you look at the
understand
30.
What happened there? It was, that was when you had a pulse, you get a house.
Yeah,
And that literally is how it went.
When you lose, I think when you go through that and you lose everything, you lose your house.
Yeah.
I think that you don't forget that, but we're basing it on that. Like, oh, that's gonna. I don't want that to happen again, and I make this decision based on that.
It's crazy.
But if you look at what you're saying, look at the last 30 years, and those are the only 3 years that it was in the negative.
It's a historic event, right?
Yeah.
The financial collapse. And then if you look at 50 years of real estate, this will blow your mind too. There was only 2 more years in the 80s where prices went down. So you got 5 of the last 50 years.
That's incredible.
And that was because of a savings and loans crisis.
I remember that,
yeah. I wasn't. I was just being born then, but you guys were probably...
Go fuck yourself.
Yeah.
But yeah. So it's very stable.
Interest rates are like 17%.
Yeah.
Yeah.
Interest rates were very high.
Yeah.
Yeah.
Probably the highest they've ever been.
We were not owning real estate at that time.
No.
Our parents were.
Yeah.
Yes.
But your parents were paying like a fraction of what a home costs today.
Correct.
Right?
Yeah.
Yeah. So one of the things, so we had the 10% in the stock market we got versus 7% over here appreciation in real estate. But the benefit of the real estate, as you guys well know, is if I can buy something that has cash flow, now I've got more returns coming my way. Not just the value of the home that I'm holding on to for the next 30 years. I've got cash flow coming in every month. And so that can vary based on the type of rental property that you buy. You could buy a Section 8 rental and cash flow a lot of money, or you could go buy a A-class property out here in West County and cash flow no money.
Which I don't understand that play. There's guys that do that. We just got our first financial report back on the 104 units that we purchased, and it's actually was there 9 vacancies out of 104?
Yeah, 8. Yeah, I think 8.
We still were able to net $12,000, so not bad.
Nice.
So get
what
those
is that
for-
like?
Thank you, Lindsay.
Unit,
thank you, Lindsay Whitaker. Amazing.
So that's about $100 a door.
She's a
or something?
great operator.
Or
Yeah,
90
it's over
hours
100 a door. Yeah.
Nice.
Yeah.
Which does that
great.
seem high?
No, that's right on par.
Yeah.
I think multifamily, you're looking at $100 a door. I think single family, you could maybe get to 200. It's a little bit more, but it's not,
I think that's to
So that once you get rid of those vacancies, even if you can fill up 5 of those at $1,000, that adds another $5,000 to that number.
It's all just bonus.
Yeah, yeah.
But you've got some vacancy.
You're talking a cap rate as it sits right now. You're sitting a cap rate of like 7 or 8, so it's pretty damn good.
But that's the key: is the vacancy. You cannot have. You get down to 80, you're in bed. You're in trouble. Oh, you're in trouble if you get down to 80%. You have to be over 90.
Yeah.
I think it'd be a good, maybe on the next podcast, we'll break down Tesson.
Yeah.
To show exactly what you're talking about. Here's what we bought it for. Here was the rental income. Here's the expenses we had. Here's when we sold it. Here's the total amount of that this investment yielded in the course of 3 years.
Well, that's why it makes 0 sense to go buy one property and have one rental. Like I always tell people, if you're going to get in the single family world, get in at least 3. Because you're going to have one that's going to get empty, or God forbid, one needs a roof.
Well, think about the 3-family.
Yeah.
It lost money last year, right?
Yep.
It lost money because we had repairs to the deck. We had a roof repair.
Yeah.
It's a good building, but last year was not a good year. It lost money.
Yeah.
But if you have other properties
that's why
make money.
The more roofs, the more sense it makes. Well, actually,
more doors, less roofs. Yeah.
So that's. So I didn't mean to cut you off.
No, yeah, you're good. Yeah.
So how do you justify then why buy rental property and not stock market if?
Yeah, it's the so if you're just looking at appreciation, the stock market wins, right? If you're going to buy this asset and not put any tenants in it, you're just going to hold it. You're going to do nothing with it. Yeah, stuff is going to age. Something's going to go wrong. Like, it's not a good comparison. But because you're renting it out, now you've got cash flow.
That's what I would say. How much does that 401k pay every month?
It doesn't pay any.
Exactly.
It doesn't pay anything at all. So then the third thing, which really makes it a game changer and why I embrace it so heavily as my vehicle of retirement, is the ability to leverage it. Okay, so when I say leverage it, I can go buy the $100,000 home and get a mortgage and put 20% down. So that's going to 5x basically the return that I would be getting putting my 20 grand into the stock market.
For $20,000, you have a $100,000 asset.
That's right. And so that's really what makes this so beautiful, because now the tenant's going to pay your mortgage for you effectively. You're able to leverage it.
So you're leveraging the mortgage for a high cash on cash return, right? Because that's one of the things that I know Kyle talks about.
Absolutely.
Grant Cardone talks about, right? Is cash on cash, and that's a perfect example of it right there.
And you've got to be smart. You've got to get good debt. And good debt is everybody in this country can get 10 conventional conforming loans. And that is the best debt you can get on the planet. It's a 30-year fixed rate interest. They can never call the loan due. It's the safest loan you could possibly get on the planet. I think there's only 2 countries that offer a 30-year fixed rate mortgage.
Yeah.
So
who's the other one?
The important thing that you said is 10. So the most they'll allow you to do is 10.
10
And
properties.
then you have to go into a commercial
Then
portfolio.
then you have to get a portfolio loan, which those can be good as well. But those banks usually run on a 5-year arm, which means it's fixed for the first 5. But then after that, the mortgage rate can adjust. They could call the loan due, stuff
on
like
our
that.
104 units, that's exactly what it is.
Yeah, and you have to.
years,
Yeah, they don't do a conforming loan.
Which I don't understand.
I don't
that
either.
part,
Like,
but,
I think as the bank, why wouldn't you, if you're paying and you're making, if the tenant, or not the tenant, the borrower is paying, why would you not want to just continue?
Well, they have reasons.
Why?
They're hoping that rates go up. So if your rate
Like, they're
adjusts
greedy,
up,
they're not making enough
Shocker,
money on it.
banks
I
are
know.
greedy?
Like,
Get outta here.
Dave, you have another reason why they don't?
Well, a lot of banks right now, because everybody got these, 5 years ago, they got a 2-3% interest rate. They're jumping at the bit to get a chance to lock you in at 6-7%. Right? They're hurting for cash right now.
Even if that means you foreclose,
Yeah. Now, the other reason why they may call your loan due is because if the market has a downturn, like it did in 2008, couple years that the market went down,
they're minimizing risk.
So if you start if the value of your property now goes below that loan amount or the threshold that they want that LTV to be at, and they do their little auditing and they find that, they have the flexibility to call it the loan due. Now, you can't do that on a conforming 30-year fixed rate mortgage. Right. But commercially, you can.
I'd rather them say, we have the right to.
Yeah.
But
they do
things are going well.
Yeah.
And we like the rate, what if the rate's lower? I mean, sure, you can refinance with them.
Costs you a lot of money.
And they're on commercial.
Either way, they're winning, right?
Yeah.
So, let's say the rates drop 1%. Is it worth refinancing? Well, probably so, but what's it going to cost you to refinance that loan?
$100,000.
Could be. Yeah. That's depending on the price of the property.
Yeah. No, it's just I wish it wasn't that way because it causes some
that's
problems in
a lot of these big apartment complexes going under right now because they ran their numbers at a 3.5% rate. Right. Now they adjust to a 7, and there goes your cash flow. Yeah. So you're seeing a surplus of inventory pop up because of that.
Yeah, it's right about that time too. You're hitting the 3 because the ARMs are usually 3, 5, or 7 years.
Correct. Yeah,
majority of them are probably 5, and then
in the next 2 years you're going to see a real influx of it.
Yeah,
which is a great time to buy. So keep hanging on to cash.
Yeah, that's the thing.
Have a good operator. Like that is so key. Is have a good operator. We got very, very lucky to find the operator that we partnered with.
That's awesome.
And I think that is the other key is don't go at it alone, right? It's like why reinvent the wheel? Find somebody that has that wheel and process.
It's about not being greedy. Because on from a 10,000 foot view is, we can make more money. Well, but there's so much that the experience of that is so important.
Right.
That,
it minimizes risk, and that's the key here. There's always
I'd rather
risk.
pay for experience than to try to learn. We've all learned enough on our mistakes.
Recently
we've lost.
We got burned. We lost $200,000.
We've all lost money on mistakes.
And then for us to go in and trust somebody enough to put $800,000 into a deal, we had to. But we knew the questions to ask, right? So there is no such thing as losing. Like it's school. School costs money, right? So we got an education on what not to do.
You guys got PhDs?
We just got a bachelor's degree in what not to do. A bachelor's degree is about $200,000.
I think we have about 20 of those degrees.
But you can't dwell on it.
No.
You look at it as school is expensive. We got schooled. Yeah. We learned a valuable lesson, and you just don't repeat those.
Yeah, and it's hard to figure out, especially for the new person. I've been through the same thing where I lost money, and it's like you go into something and you don't know what you don't know. So it's like this thing that you should know about, but you don't know you should know about it. And it's like, how are you ever going to find that out unless you partner with somebody that's already been there, already done it, knows to look for that. And it's not something that you're going to read in a book or see on a YouTube channel. It's like you need somebody there doing the deal with you.
Yeah,
that's
we just had an agent in our office yesterday. She's like, I want to start getting into rehabs, and she wants to start investing. She's like, I'd love for you guys to help us. And what did you say to her? It was a great answer.
I don't even remember.
We can tell you everything what you shouldn't do because we've done it. For sure.
That's a great.
So I'm like, that's
true though. We've all done that.
And we still make, but that's part of it. Like if you're not making mistakes, you're not growing.
The biggest thing is getting back up.
Yeah.
Like getting back up, trying it again. In learning from why you failed. So that's important. And you should pay for that. You should be willing to pay for that.
School's expensive. It just cost me $100,000 to send my daughter to college. This is just a form of school. So you're gonna have hiccups. You're gonna have some bumps and bruises, and you're probably gonna lose some money. That's just part of it. But you nailed it. You have to be able to get back up and keep on rolling.
Yep.
Okay. Yeah. So I'll wrap this up real quick with the results of this study that I was doing on the 401k versus the rental property. Just to tell you little high-level details, we put in $20,000 into each method up front, with the stock market returning the 10%, with the real estate returning the 7%, with a mortgage, with some cash flow, with appreciation, all that stuff. And then we fast-forwarded 30 years to see what each investment would do. And so in the stock market, at the 10% compounding over 30 years, we ended up with like a little over $350,000 as our return. So that's pretty good.
How much did you
I put
in?
in 20 at the start, reinvest all of the profits.
That's incredible. That's great. Do both.
Yeah.
Do both.
Compounding interest.
Yeah.
Right? It turns into a big amount. And I saw that. I was like, man, that's going to be pretty tough to get.
Yeah.
Over here on the real estate side, though,
I know you killed it.
We had about $300,000 just from the cash flow of the rental,
and then the appreciation of the house.
And the appreciation of the house bumped it up another $700. We had some debt pay down in there, paying off the mortgage, and so we were up just over $1 million on the real estate. So we could conclude it was about a 3 or 4x from going from 401k to just one rental house.
That's huge.
With a $20K investment.
That's huge. Plus, there's a tax benefit.
Yeah.
On the home.
Right.
Did you put that?
We didn't put any tax. We said, hey,
not on the other.
We
one.
pretended.
Let's back up a second. I'm gonna question these numbers.
Yeah.
So on the 20,000, that means you bought $100,000 house.
That's correct. Yep.
So you're saying 30 years that $100,000 house is worth $700,000?
You're exactly what I got caught up on at the end of the study.
Okay.
So I picked out a house. It was. I think it was in Veneta Park.
Okay.
It was in a rough spot,
Yeah.
but it was completely renovated, like beautiful home, ready for a tenant at top of the market rent, which is $1,400 a month for a 3-bedroom in this area.
Okay.
And it's $100,000 house, and you 7% appreciation every year. 30 years from now, $100,000 turns into $700,000. And I'm sitting here thinking my study's broken because nobody's paying for a house in Veneta Park for $700,000.
Correct. Right.
And I was like, I can't tell people.
How much was that house in Veneta Park 30 years ago?
And that's exactly what happened. So I was like, I can't go and tell people it's going to be $700,000 because I don't believe it myself.
No way.
But then I was like, well, how would I check? Well, let's go back 30 years and see what the houses were selling.
Right.
In this particular house, I just went on.
It was probably $7,000.
You're exactly right. So I went on Zillow and I just picked the $100,000.
You lived in that house, that exact house.
Clicked on it. I went to the tax records. Sure enough, September 16th, 1998, the house sold for $6,800.
Okay.
No lie. That was 14x from where it was today. So it had a 14% appreciation to get to where $100,000 today. So we're only projecting half of that going the next 30 years. So my mind was blown.
No.
Because it was like that was. Because back then,
well, what the fuck is a loaf of bread going to cost?
I know.
If that house in Venetian Park is $12, yeah.
Well, in 1998, if you would have told the homeowner there that your house is going to be worth $100,000 in 2025, they would have told you to go F off, right?
Yeah.
Well, it's the same thing today. It's just we're going to 2055.
At some point, it has to stop. Yeah, I get the numbers, but that's crazy.
Yeah.
Like that's actually very scary to think about. Yeah.
It is. It's like, man, that's a lot of money.
That's crazy. Yeah, that's interesting.
But 30 years is a long time.
30 years is a long time.
It changes so slowly that when we get there, it won't seem like it's that big of a deal to pay.
Yeah, you're right.
Yeah.
Yeah, that's crazy.